Dawson Ransom of Ransom Asset Management, and tell us your worldview.
Yeah, I mean, I think I agree with what everyone said so far, that there are a lot of significant challenges. What I think is really interesting is that the actions of the Fed, both fiscal and monetary actions, have been relatively successful in mitigating what could have been a significant issue with related to COVID. The question is, the inflated asset prices that come as a result of that, and the psychology that goes along with it. To me, what I'm most concerned about is when that unwinds and how violent that may be as it changes. So, when we see tapering, when we see rates rise, history is a guide that probably the Fed will get it wrong. So, how long is it going to be when that happens? And what is the downside to the market at that point? So, I mean, those are the things that keep me awake at night, I guess. And then, anecdotally, just the psychology. It doesn't take, a great deal of insight to see that there is very positive sentiment. So a lot of risk taking, a lot of assumption about future returns, a lot of belief and faith. And so, just logically, the more of that there is, the more concerned I get. And I think, Wayne made a good point about, bidding up of the beneficiaries of COVID. And, that was one sign that was, I was somewhat amazed and troubled at the same time watching that happen. And then you have a rotation. And you have some of the reopening names and some of the value names that have done very, very well, from the end of last year. So, and then you have digital assets, which are getting a lot of play, and some of that potentially for good reasons, some maybe not so much. That's again a different webinar.
The father and son team, Cornell Bowden and Greg Bowden from Sheetsmith Investment Management, and let you guys share some thoughts when you look at the macro view of the world.
I don't know what to add, what everybody else has said, because we agree with so much of it. I would say we've been wrong for a long time because we thought interest rates were going to go up, but it looks like we're now finally going to start shining again. We've been very short in our fixed income investments for probably 5 years, but it just didn't make a lot of sense when interest rates were 2.5% to go along when you're watching bid on 1.5%, but that would have been the right thing to do, but it would have added a lot of risk to our portfolios. And we want to stay away from that. But debt is truly a problem. And just yesterday, listening from what Druckenmiller had to say to the report on the CPI today, clearly we got a problem. And whatever commodity you want to look at for the last year, all the charts look like this. So, and just you're talking about anecdotal. A friend of mine is building a house down at the coast, and he needed a piece of lumber that was, a 2 by 12 by 16 feet long, and that would normally cost him $25 to $30, and now that same board is $85. That's a significant change when you're trying to build a house, and one piece of lumber costs you $85.
Yeah, go ahead, Greg.
Yeah, what's keeping me up at night is what are going to be the impacts of the inflation that we're seeing. And when I look at the chart of the Treasury yields in the 1980s, they were in the mid to high teens. And there has been a steady trend over the last 40 plus years, all the way down to zero. And there are very few managers that have been around that long to have ever experienced something other than declining yield rates. So the entire industry is going into new territory that the correlation between stocks and bonds could essentially go to 1, as Wayne was referring to. The bonds are not going to be a place to hide because of the low rising interest rates. And as interest rates rise, it's just going to increase the cost of equity that everyone's using to calculate value of stocks. So I'm definitely afraid that the industry as a whole doesn't know what to do in a long-term rising market, and everything's going to go down.
Arun, why don't I throw it over to you? Arun Kaul, Chief Investment Officer, BX CIO. We heard a lot of talk around inflation, interest rates, and monetary policy. Do you care to comment on that and or anything else that you're seeing from a macro view?
Yeah, I think they're all great comments. I think bottom line is that the rules have changed in many different facets. So when we look back historically at what may or may not have occurred, we just have a different set of rules today. We have a different structure. I think some of the different structural issues are overlooked in some of these discussions. To Wayne's comments about disconnect between earnings and markets, if we look at ETFs, by definition, they're not following fundamentals. They're following themes. They're following different groupings. They're following different mission-driven strategies. They have nothing to do with fundamentals. They're organized around different categories. So I think it makes sense that there's a disconnect. I think it continues because obviously ETF growth is continuing. Active and passive, more than half the market is now passive. So they're not looking at fundamentals either. And they trade on completely different criteria. So there's fewer and fewer managers that are actually looking at fundamentals. And as we're seeing, there's less and less response to fundamentals. And this is a challenge for all active managers. We've removed the cost of trading. There's no cost of trading. So there's no cost of trading. There's no friction. If there's no friction, there's nothing to really hold anything in place. And we have high frequency traders now, not market makers. So it's really hard to discern when there's stress in the market because the bid-ask spread is always a penny, which in the past, when the bid-ask spread widened, that was a pretty significant sign that we have stress in the market or there's a difference in how players are seeing the market. And we don't see that anymore. We just see penny trading at 100 shares. So these structural differences, I think, are underpinning a lot of what we're seeing in the marketplace. And to Arthur's comments, legitimately, there are things that have changed, but they're playing out over 3 or 4 or 5 or 6 years. And in today's market, the market velocity is about 7 or 8 or 9 month hold. So there's a huge disconnect between what may happen and what probably could happen in 5 years from now and how the market might trade for 9 months. And we're seeing that right now. Obviously, a lot of these aggressive growth names or innovative names that arguably, to Wayne's point, did trade at too high a multiple and now have to come back down to some other multiple. In the meantime, they're down 30 or 40 or 50%, even though they may be the winners and they may be the ones that are standing 4 or 5 years from now. So I think all of these are challenges for active managers. And to Larry's comments about post long-term capital in 1998, the Federal Reserve and central banks have changed the rules completely in terms of how we measure investments. And I don't think anybody can still explain what negative interest rates are, but somehow we have to pretend that's normal and that we can still do finance in negative interest rate world. It makes no sense. But we're asked to make sense of something that doesn't make any sense in terms of how you value assets. So I think all of those themes are underpinned by a lot of these structural changes, changes in rules that are driven not by finance, but by policy or regulators because they're trying to control some other aspect of the economy.